Well, good afternoon, everybody. Welcome to our second episode of tax tips, tax seminar. So again, we're going live, so you'll have to forgive me if I sometimes seem a little bit lost, but I'm trying to do my best to stay on course because we cannot correct ourselves. It was kind of funny as we were testing. I never noticed to what point my head shines. So someone would almost believe that I had a buff done this morning with some wax. So it's kind of funny to see that. Anyways, getting right into it. What we're going to talk about today is kind of a follow up to last week. So, last week, for those who joined us, we talked about what expenses were deductible and which ones were not. And so, what we're going to tackle today is is a continuation from last time, because I had mentioned last time in the presentation about capital cost allowance, which is another word for depreciation. And I just skipped over it because that in itself is quite a discussion in itself. So today we're going to talk about capital cost allowance. Like I said, is another word for depreciation, what it means, and what it is exactly. So what capital cost allowance, it's a way of recording a capital cost expenditure over several years. So for example, if I buy a piece of equipment for say $10,000, CRA does not allow me to deduct the whole $10,000 as an expense because it is not a current year expenditure. A capital asset will be used over several years. It has a life of several years. So because of that, the expense will be separated and extracted for each year. So the way it works is that, so let's say you make a $10,000 expenditure, a portion of it will be allocated to each year. So first of all, let's define what a capital purchase is. As a general rule, a capital purchase is an item that has a life of longer than 1 year. Now, that in itself is not a good enough definition because I could go to Staples, buy myself a mechanical pencil like this. And this mechanical pencil I've had now for something like 5 or 6 years. So one would think, well, it has a life more than 1 year. I would depreciate the cost of the pencil over 5, 6 years. Well, of course, if the expenditure is only $5, you're not going to capitalize it. So it has to be of a larger amount of money. So a $5 expenditure that lasts more than a year will not be capitalized, but rather just written off as an expense. So it has to be of a significant cost. And as a general rule, more than $200, and for a lot of people, depending on the size of the business, they'll make the line as being $500. So that's where we draw the line to some degree. And how it is calculated, well, CRA has defined how we calculate depreciation or capital cost allowance on a declining balance method. So basically, what we do is rather than spread the cost evenly over several years, there's a higher capital cost allowance or higher depreciation in the first few years, and the amount that you can claim goes down as the asset goes down in value. And so the way it's calculated is based on the class that the asset falls into. So every capital expenditure will fall into a separate class according to the Income Tax Act. Now, if you were to look at the Income Tax Act, there are many classes out there. So what I'm going to do is describe to you just a half dozen classes that are more widely used. But like I said, every asset will fall into one class or another. And it's amazing, kind of surprising, in fact, how many different classes there are for very specific assets. For example, spacecrafts is class 30. Well, how often do you know of people who buy spacecrafts to depreciate it? That's not terribly common, but there is a separate class for spacecrafts. So the classes that are more commonly used are the following. Class 1. So class 1 are buildings that has a foundation below ground level. So an example of a class 1 asset would be a house, because a house almost always has a foundation that is below ground level. A class 6 asset is a building that does not have a foundation below ground level. So an example of a class 6 asset would be a barn, a garage, a shop, granaries. All of those things will generally fall under class 6 asset. The next class that is very commonly used is class 10. Class 10 are self-propelled equipment. So trucks, tractors, automobiles, anything that's self-propelled will fall into class 10. And the other thing that falls into class 10, which is kind of strange, are trailers. For strange reasons, trailers are also considered as a class 10 asset. The other class that's often commonly used for truckers especially is class 16. So class 16 is the semi-truck, the tractor part of the semi-truck, because the trailer will fall under class 10, but the tractor will fall under class 16. Now, each one of these assets that we talked about so far have a different rate of depreciation. So, for example, I just talked about class 1. Class 1, the rate of amortization for that one is 4%. The class 6 is at 10%. And then class 10 that I talked about is at 30%. And class 16 for the semi-trucks is at 40%. Another class that's often commonly used is class 12. So class 12 are small tools, generally having a cost of less than $500, or software. So those two assets are considered as class 12, and the rate of depreciation for those is 100%. And then finally, computers. And if I'm not mistaken, computers fall under class 50. And class 50 is defined as data processing equipment. So generally that'll include computers, laptops, things like that. There's always quite a discussion, and I don't know where the verdict fall on that. I'd have to research, but things like GPS, some people say it's class 50, some will say it's class 8. I'd have to research as to which class it falls into. I should have done the research before today, I just realized. And the other class, which is the class that's probably most commonly used, is class 8. Class 8 for farm assets would be all your pull type machinery. So most of the smaller assets on the farm that are not self-propelled will fall under class 8. And class 8 will also include most of the day-to-day assets that most people use. So even for those of you who have an office business, your desk and things like that will all fall under class 8. So class 8 is probably one of the assets that are most commonly used in income taxes. So now that we've defined by the way, class 8 is depreciated at 20% per year, so smaller than other assets. So how this is all calculated is based on the cost. So let's just say you bought yourself a piece of equipment, a self-propelled machinery, or sorry, not a self-propelled, but another piece of machinery that is not self-propelled that we would classify as class 8. And let's just say you paid $10,000 for that class 8 piece of equipment. So I just explained a few seconds ago that class 8 is depreciated at 20% per year. So how this would be calculated, so if I bought a piece of equipment for $10,000 that is considered as a class 8 asset, the depreciation that I could claim on that would be at 20%. However, CRA in the year of purchase assumes that you only own the assets for 6 of those 12 months, therefore half of the year. And therefore, this is where the half-year rule comes into play. So regardless of whether you bought the asset on January 1st or December 31st, so whether you owned it for 364 days or just 1 day, the depreciation in that first year will always only be half of that half-year rule. So if your asset depreciates at 20% per year, then because it's a class 8 asset, it will be considered in the first year only a 10% depreciation. So going back to the example I just gave, you bought yourself a $10,000 piece of equipment. It is considered as class 8. In the first year, because of the half-year rule, you will only calculate the depreciation not on the whole $10,000, but rather on only $5,000. So the maximum capital cost allowance that you can claim in the first year would be the 10,000 times 50%, therefore 5,000 times 20% being your CCA, your capital cost allowance, giving you a claim of only $1,000 in the first year. In year 2, what happens now is that you get to claim the capital cost allowance on the balance that is left. So going back to the example, I've got myself a $10,000 asset. You take the $10,000, you minus the $1,000 that you claimed in the first year. So we're left with $9,000 to claim in the years to come. So in year 2, I would take the $9,000. 20% of that is $1,800. So the maximum amount that I can claim for capital cost allowance in year 2 would be $1,800, being 9,000 times 20%, therefore $1,800. And in year 3, it continues on. I take the $9,000 I had left at the beginning of year 2, subtract the $1,800 of CCA that I claimed in year 2, and that leaves me with a balance, or referred to as undepreciated capital cost, of $7,200, being the 9,000 minus 1,800, giving you 7,200. So in year 3, what you'd be able to claim for capital cost allowance would be 7,200 times 20% again, giving you the $1,440. And it continues on year after year. And every time you buy a new asset, it gets added to the class, and the half-year rule will apply to the new asset only, and we will claim the depreciation on whatever is left. So at this time, I'm just going to take a few minutes. Are there any questions out there on what I've discussed so far?
Hey, Jean-Guy.
Hi, Kayla.
So it looks like there's no questions at this time. For everybody listening out there on our live show, if you do have any questions, please just post them to our chat and we're going to answer them live.
Okay. Thanks, Kayla. Okay, so this is going to be a fairly short session because capital cost allowance isn't, it is fairly complex, but I'm not going to get into all of the rules related to the capital cost allowance, such as disposals and things like that, because that becomes fairly convoluted. So I'm kind of sticking to the points that I think every business owner needs to understand, and restricting my discussions to that, so to the purchases basically. So one of the questions we get often whenever we talk about capital cost allowance is, when is an asset considered to have been purchased? So for example, someone goes out and buys a tractor on December 24th, but the tractor is not available for use. In other words, it is not yet delivered to your property or not available for you to use. Can you claim the depreciation of that asset in that year and get rid of that half-year rule right away? So in the event where you bought an asset and it is not available for use, the asset is deemed not to have been purchased. So you could go to a dealer, buy a tractor on December 24th, but they don't have it in their yard. It's not available for you because they got to get it delivered from another province or something like that. If it is not available for use, even if you paid for the tractor, you signed the deal and everything is done on December 24th, because that piece of machinery is not available for use, you cannot claim the depreciation you would otherwise be able to claim on December 24th. So you got to make sure that that asset is available for use. But available for use means that you have access to it. So someone, for example, buys a combine, so a harvester for a farmer on December 24th, but leaves it on the lot to be picked up at the farmer's desire. That asset would be considered a purchase because it is available for use. Now, what are the odds that he's actually going to use it on December 24th? Well, probably slim to none, unless he puts a plow in front of it and decides to plow snow with it. It's not likely going to get used until the following fall. But nonetheless, the combine is available for use. If the farmer wanted to, he would just simply have to go over to the dealer to pick it up. And because it is available for use, it would be considered a current year purchase. The other question that we often have with regards to purchases is with regards to any additions made to that piece of equipment. So, for example, I buy a truck and I buy an old truck that's maybe been written off but doesn't have a working motor. So I may be able to get that truck for a really good deal. And I buy the truck, say, at the end of December, but I have not yet put a motor in it because it needs a new motor. That purchase is not deemed to have happened until it is in working order. So all the money that I put into the truck and making it available for use would be capitalized. So a lot of people will say, well, I bought a $10,000 truck and then put $15,000 of repairs. And what they're going to do is put the $15,000 as a repair. That is not allowed. What you would have to do is the $15,000 spent on repairing the truck so that it is become usable will get added to the cost of the truck and then depreciated from there going forward. Where this question comes into play even more often are with properties such as real estate. So it's not uncommon for someone to buy a house for the purpose of renting it out. And once they buy the house, they will spend another 10, 15, 20, $30,000 making repairs to the house to make it leasable, to make it rentable to tenants. So all of the costs spent in making the house available for use will all get capitalized and will not be written off. And the repairs will only become a repair once you're actually using it. And then after that, those repairs, depending on if it's an addition to the house or a renovation, will generally be written off as a repair. But until you've actually made the house available for use and you've got tenants in there, all money spent on repairing the house will fall into a capital purchase, be added to the cost of the house, and depreciated from there on in. Now, the other thing you need to understand is, and I'm not too familiar with the American rules, but I believe in the United States, depreciation is something that you're kind of forced to claim, whether you like it or not. But here in Canada, capital cost allowance is not obligatory. It's optional. So let's just say you're starting off a business, you've bought $100,000 of equipment, so you have now access to claim a lot of capital cost allowance to reduce your taxes, but your profits in the first year are minimal, and you don't need to claim that depreciation for the sake of saving taxes. You are allowed to not claim any depreciation in the first year. Now, why would someone do that? Someone may ask. Well, the reason you may not want to claim CCA in a given year is to keep that class of asset high. So remember that $10,000 piece of equipment. Every time I claim capital cost allowance, the book value of that asset goes down and therefore reduces what I can claim for capital cost allowance in the following years. So unless you really need the capital cost allowance expense in the current year, it's not a bad idea to hold off claiming it until such year where it becomes very beneficial. And for a lot of our cases and clients that we've been dealing with, sometimes claiming it in the current year will save taxes. We'll still refrain from claiming it simply for the sake to hold off and claim it more in a year when we know it's going to be taxed at a higher bracket. So it's really up to you as to when you want to claim that capital cost allowance. And like I said, there's a whole lot of information for someone to be able to calculate properly how to calculate your capital cost allowance, especially if you have a disposal of assets. And we're not going to get into that. So I'm going to probably just keep it to what I've done so far with regards to discussing capital cost allowance and not dig too much deeper into that, because what's going to happen, it's going to become horribly boring for the most of you. And for some of you, it might be just too complicated than you want it to be. So, and plus, I could go on for hours on how to fully calculate depreciation. So at this point, Kayla, are there any questions?
Hey, Junkie.
Hey, Kayla.
Doesn't look like we have any questions at this time, but let's just confirm a comment that Joshua mentioned here. So in theory, can we depreciate to $0?
In theory, it never happens. The only time it depreciates down to zero is in the year you sell it. So, to give you and I think that's a good question. So, to give you an example, let's take a look at that piece of machinery that I bought for $10,000. I depreciated 3 years, and after the third year, the UCC, that is the undepreciated capital cost, is down to something like $6,000 or so. In the year that you sell all of the assets in the class, whatever's left, then that will be claimed. It's not called the CCA, but rather called a terminal loss, but it's the same thing. So basically, it never really depreciates down to zero. It'll continue having it, always having a balance in there until you sell all of the assets in that class, or the assets go down to zero because you've disposed of enough assets. That can happen too. But now we're getting into more complicated, complex stuff. Any other questions?
That looks like it for this time.
Okay. So like I said, I'll end off by saying, just like in the prior episodes we've done, if you have any questions, by all means, you're welcome to send me those questions by email, and I will do my best to respond to them in a reasonable amount of time. My email is jg.talbot@talbotcpa.ca. And if that was too fast for you, go on to our website. On our website, you'll see everyone's email on there, so you can email me, look me up there. And other than that, just remember that if you like this, please subscribe, number one. And number two, we're going to have these episodes happening every week. So we have a different subject every week. So next week, what we're going to talk about is wages to family members. So basically, whenever you're in business, you are allowed to declare wages paid to family members. And we're going to talk about the what's allowed and the dangers of paying wages to family members by way of CRA being not agreeing with what you're paying them as being reasonable. So we're going to talk about all that next week. So please tune in again next week. This is what we're going to talk about. And again, similar to this week, the next week's session should be about 20 minutes as well, not much longer. So unless there are any questions, Kayla, I will be signing off. Anything else, Kayla, that I should add?
Hey, Chunky. We actually got one more here.
Oh.
So from Joshua, can you defer CCA for only a year? Or if you have a choice of deciding which year you want to claim based on how much you earn per year?
Yeah. So CCA can be deferred for as long as you want. It doesn't have... because the pot never goes away. So, but it doesn't accumulate. So just in case you're wondering, in year one, in the example I kept giving, is the $10,000 in year one, you could claim $1,000 of CCA. If you don't use it in the first year, it's not like the second year you can claim first year's depreciation plus second year's depreciation. What happens is just that the class of assets stays at a higher amount, therefore allowing you to claim more in year two. But every year that goes by, and it's not uncommon for a fairly new business where we won't claim any capital cost allowance until year 3, 4, or 5. If it takes several years for that business to become very profitable, we may hold off claiming any amortization or any capital cost allowance until year 3, 4, 5. And again, the advantage of doing that is every time you're buying assets and gets added to your pool just goes up in value and allows you to claim more and more in that year. So no, there is no time expiry on that. You can just keep building it up until such a time as you do need it. And it does happen with a lot of our businesses. And also keeping in mind that in certain cases, claiming capital cost allowance may not be to your advantage. So the example that I often give is for example, a building. So if I buy a $200,000 building, I can claim capital cost allowance on that building over the years to come, and it'll help reduce current year's taxes. But you got to remember that in the year of sale, if actually the value of the building went up in value, the book value would have gone down. So to give you a perfect example, I buy a building for $200,000 and I keep claiming maximum capital cost allowance year after year after year. After 20 years, that $200,000 asset will be depreciated down to, say, $100,000. And then what happens when I sell the asset, sell the building, And if I sell it for more than 100,000, anything that I sell it that is over and above the $100,000 mark will have to get added back into income. So because building tends to appreciate, it's not uncommon to have a $200,000 building depreciated down to 100,000, and then we sell it for say 250. Then what happens is the whole amount that was claimed as depreciation over all these years will all get added back into income in that year where you sell it. So if you've got a building that you pay 200, depreciated down to $100,000, you will have to kick back into income the $100,000 that you claimed in depreciation throughout all these years, which, because it's all included in that 1 year, plus the capital gain on top of that, it can really hurt. So that's why at our firm, we think twice before depreciating capital or buildings or any asset that tends to appreciate with time, because you got to give some thought to that as to whether it's really worthwhile doing. Any question that came up with that, Kayla?
We do have one more.
Okay.
Do we prorate CCA or just use the half-year rule? For example, if an asset is bought in November, can we still use it for half a year or only for November and December?
No, so it doesn't matter when you bought the asset. It's always half-year rule. So whether you bought the asset on December 21st or beginning of November, it doesn't matter. It's always half year. So that's why we tend to recommend, if you're going to buy an asset in early January, you might want to give some thought to buying it in December so you can claim the depreciation in the first year, but also get rid of the half-year rule because it is deemed to have been purchased halfway throughout the year. The only time that it gets prorated is if your business was not in operation for a full year. So let's just say in the example, you started your business on November 1st, then you would only be able to claim 2/12 of the CCA plus the half-year rule. So in the example of the $10,000 purchase, if I started my business on November 1st, bought the asset on December 15th, the calculation for the $10,000 purchase would be 10,000 times 50% for the half-year rule times 2/12 because I was only in operation for 2 months times the 20%. So in a short year, it will get prorated over and above the half-year rule. All good?
That looks like all of our questions.
Okay.
Are you wrapping up, Shungi?
I am wrapping up. So again, I'd like to invite you to join me again next week, next Tuesday at 1 o'clock at the same bat time, same bat channel, and we will talk about wages to family members. Thanks for joining me. I appreciate you joining me. It was a lot of fun. Thank you. Bye-bye now.